Hello, everyone. I'm Steve Abernathy. I'm the CFO of the World Floor Covering Association. Welcome to Profit Matters. It's great to have everyone on the webinar today. We got a great number, looks like, coming in. Probably have some more coming in before it's over with. But we're very, very excited to be here, to have you here as we kick off a brand new webinar series for the WFCA on the topic of, well, profit matters. It does. And that is the subject matter that we're going to be talking about. Profit Matters is part of a broader platform, if you will, initiative here at the WFCA called Studio 59. And Studio 59 is our newly created digital content platform for communication, financial education, leadership training, and much, much more. We've got a lot planned for this and looking forward over the next several months, weeks and months, to bring you all kinds of content for educational purposes and also to help you better your business. And that's what this is designed for. Just a couple of quick housekeeping issues. This is a 1 hour scheduled webinar today. We're going to try our best to keep it at 1 hour and not go over. I like to talk, so I'm sorry it may be difficult for me to do, but we'll give our best shot at it. It's one way. It's not a traditional two-way Zoom call like you may have been used to with us before. And primarily because this is more educational and training in nature, and it just works better for us. However, we will have a Q&A session at the end where you can submit questions, and I'll be glad to try to answer any questions that you might have. Also, if there's questions you have that you are not able to attend on the live session, certainly send those to us and we'll be glad to try to get answers to those as best we can. So as we do that, I'll just start with just a little bit about me, if I may. I am celebrating, if you want to call it that, 37 years in the flooring business, believe it or not. And I'm only 37, so I've really been doing this since I was born, and nearly 30 of those years were at Shaw. I'm just kidding about being 37. But nearly 30 of those years were at Shaw, and I'm an industrial engineer by degree. So my first 8 years in the flooring business was in carpet manufacturing. I worked on things like cost, I worked on plant layout, process improvement, those types of things that IEs do in carpet manufacturing. After that, I've got about 5 years of logistics experience setting up distribution centers across the country for Shaw and getting those up and running, handing those off to a manager and doing it in another city. So I've got about 5 years of that experience. When Shaw entered retail, I wound up, as time went on there shortly, I directed the operations activities of Shaw's retail venture. So I really got heavily involved in that retail venture. I managed installation, warehousing, back office operations, all the things that we did related to non-sales activity with that retail effort. We had 400 and some odd stores. I supported those stores with my teams and warehouses, things like that. After we sold that business, I moved over to digital marketing, or excuse me, I set up sales automation for our 1,100 member sales force. We brought technology for the first time to our sales force. I was highly involved in that and starting that up. And then beyond that, I moved on over in technology for marketing, and I was the head of digital marketing and advertising for the past 10 years I was at Shaw. I have started and ran at times multiple successful business ventures. I've started them for myself. I've also started those for several other people and entities, including several here with the WFCA. I have considerable consulting experience in the industry. I spent quite a bit of time working with retailers and other dealers to improve their businesses, some of which were in pretty dire straits, maybe recovering or trying to prevent bankruptcy in their business. I was able to spend some time helping and work with them to make their businesses better and sometimes save their business from bankruptcy, as I said. 7 years ago, I joined the WFCA, and I've been here overseeing the finance, HR, and technology areas of WFCA. So that's kind of a little bit about me. You may not fully have heard of me or know who I am, but at least that gives you a little bit of background to who I am. Enough about that. I don't like really talking about me anyway, so let's move on. Okay, so expectations for this new series that we're doing. We've got a lot planned, a lot on the plate. The goal here is not to make you an accountant. And when we talk about finance and accounting and things like that, that's not the goal. If you want to be an accountant, go study that, I guess, in college or something like that and be an accountant. But what I'm really focused on more than anything is to really address finance, accounting, business management from an owner-manager perspective. And as I said, it's not to make you an accountant, but help you to understand that business from that perspective and to understand key financial concepts and how those concepts impact your business. You know, so many retailers today, so many dealers today, regardless of what their segment is, they may not have adequate training and or background in finance or in business management, or maybe they started as an installer and then they started opening up and selling goods and wound up owning a store. And so they really don't have that financial background to look at financial statements, to understand what's going on in their business. So that's my goal, is to really try to dive into that and help you understand that. Now, if you're an old hat at finance and accounting, this will probably be a lot of it review, but hold on there with me, because I think I'll be able to share some things that'll be meaningful for you old finance hats that are out there that may join this as we go along. So understanding these key concepts, how they impact your business, how to read and understand financial statements, P&Ls, balance sheets, those types of things. You need to really understand how to do that, how to look at them, how to interpret them, how to apply them to your business, how to calculate key financial ratios, and what to do with them once you do. We'll talk maybe about budgeting process, the importance of that, how you go about doing it, what do you use it for down the road. Those are all some things that we're going to look at over the course of the series of this. We're not going to do it all today, so don't get too excited. We'll look at revenue and expenses and dive deeper into those as time goes on. Capital concepts, you might even know what that word is. You might be thinking, you know, Washington, D.C. or somewhere. No, it's capital is a whole different concept when it comes to finance, and we'll take a look at what that is. It relates to fixed assets and depreciation, which we'll also probably look at in a session or so. And then much more. We really are just getting started here. I've got a lot of topics planned over the next few weeks and months as we begin to roll this out. This is a series. One session builds on the next. So with that, I hope you'll tune in and we'll get after it. So in addition to that, and along the way of learning about these concepts, we're also going to be doing something called benchmarking. And I want to explain benchmarking here in just a moment. But benchmarking is the way you get to profitability improvement, at least one of the ways. It's an important aspect of getting to profitability improvement. So when we look at benchmarking as a whole, I want to just describe what I mean by that. And you may not have ever heard the term, or you may not have ever participated in something like benchmarking. So many years ago, and if there's those of you on here that are old hats with the WFCA, you will probably remember many years ago, the WFCA commissioned a series of annual reports where they surveyed their member base as to their financial, their financial numbers. They asked for their P&Ls, their balance sheets, all of their financial data. And they produced a report called the Financial Management Report. I actually have a copy of a very old one right here. This one's from 1994. And it was actually from the American Floor Covering Association and the World Floor Covering Association. So this was when either at the merger or prior to the merger between the two, before it came to WFCA. I suppose, at least that's what I'm thinking here. You again can correct me if you know, but this was from 1994. And it's fascinating as I go back through and look at some of this old data and compare it to what I'm going to talk about here in a little bit in terms of our data today. This is one from 2005. This is the last one that I have. There may have been others. If there are, please let us know. I'd love to have copies of any others that you may have earlier or later than this. If you want to donate those to WFCA for our archives, I'd be more than happy to take those off your hands. But nevertheless, that's what we did years ago. This was an invaluable tool for a lot of our members for many years. We used this thing for many years. I personally use this. As I mentioned before, I was doing consulting work, and when I did, I actually purchased and used this report as the basis for consulting with dealers that were having financial difficulty, looking at the concept of benchmarking. But we don't do that today. Today, we've got a brand new business intelligence tool. And that business intelligence tool is powered by a partnership with RFMS. Most of you are familiar with RFMS. You know, that's a software platform, one of the many for our flooring industry. It allows us to get access to aggregated, anonymous data from over 1,000 flooring dealers. Now, I want to make sure you understand, anonymous means we don't have access to individual businesses' financials. We just don't have access to that. All we have is aggregated data. But quite frankly, that's not what we're, individual data is not what we're looking for. What we're looking for is something you can benchmark your individual data against. And that is why we were so excited to work on a project with them to bring this to life and to really do what we did here very, very manually and difficult. We made it automated. So we have really what's, almost real-time access for retail associated businesses, for commercial businesses, for builder, for regional and size segmentation. We can do regional segmentation, size segmentation, store type segmentation. We can slice and dice the data a great number of ways. And as I said, near real-time data feeds. So this is the platform of data that we're going to use to work in these benchmarking ideas and benchmarking concepts as we go along the way. So with that, I want to just dive right in. So the first thing we're going to look at is some basic financial concepts and terms. So you probably are familiar with two sets of reports, or two reports that you get from your accountant or bookkeeper, or maybe you prepare them yourself. One is the income statement, which we also sometimes refer to as a P&L, a profit and loss statement, and another is a balance sheet. And so an income statement really tells you how have we done over a specific period of time. So a month, a quarter, a year, that's looking at your business activity over a period of time, and it tells how have you done over that period of time. Whereas a balance sheet looks at what are we worth? What are we worth? And it is as of a specific date in time. So when you look at those two things, they really tell a really clear picture of your business and how it's performing, and both over time and at a point in time, and the health of your organization. So, going back now to the income statement, if you look at the left-hand side here, you'll see that there are components of the income statement that is very important to understand the financial concepts on. The first one is revenue. So you have revenue, which some people get confused with income. Revenue and income are two totally different things. Revenue, excuse me, is what we oftentimes call top line. We'll refer to that as our top line. And there are two types of revenue, just as there are expenses. There's operating revenue, which is your sales revenue, and non-operating revenue. I'll show you that a little bit clearer here in just a moment. Then the next item you have is cost of goods sold, which represents the cost of those items that you're generating revenue on, those things that you sold, right? And you have operating and you have non-operating expense that offsets a lot of those revenue items that you're so proud of. You got to pay the bills, right? So that's where you come into the expense categories. And then at the end of the day, what you're really getting after is income. That is that net, either gross or net income for your business. And net income is what we call the bottom line. On the balance sheet side, you have assets, both fixed and variable, and you have liabilities, and the net of those two is how much you're worth. It's called owner's equity. All right. So with those concepts in mind, let's dive just a little bit deeper into the basic structure of an income statement. So your accountant brings you your income statement, your P&L, as you might call it, and it looks something like this. And this is the general concept to understand. You start with revenue, it starts up at the top, and it is your sales. It represents the sales of your goods and services, as we will look at here in a moment. You subtract from that the cost of those sales. We call it cost of goods sold or cost of sales. It includes some things like product cost, installation cost, and some other things we'll look at here shortly. But that subtraction of revenue minus cost of sales gives you what's called gross profit. We call that margin. It is either expressed in dollars or as a percentage of that revenue of those sales. And that's the basic structure of getting to gross profit. And that's really what we're going to mostly focus on in this session today, is really just looking at gross margin. Getting to gross margin, getting to the gross profit side of it. But in addition to that, on your income statement, your P&L, you also have, as I said, operating expense. So from gross profit gets subtracted operating expense. Those are all the expenses of running your business, apart from the cost of goods that you've sold. That yields what's called operating income. It is the net of your gross profit and operating expense. And I'm going to explain operating versus non-operating here in just a second in a little more detail. Then you also take from that, you add back any non-operating income. So interest is one good example of non-operating income. You're not actually doing or selling anything if you've got money in the bank and you're earning interest. That would be a type of non-operating income. And then you subtract from that your non-operating expenses, and you get what's called net profit or income before tax. And that's what you really can spend, or at least after tax, you can spend it. But nevertheless, that's the basic structure of an income statement. That's the basic structure of the concept of going from top line revenue to bottom line profits. And understanding that and following that along as we go, we're going to dive deeper into all of these and what impacts them, and how to move those needles on those numbers and which ones are most important as we get through this series and move forward. All right, so let's do this. Let's take a look at, if we can, a P&L from our benchmark data. Now, our benchmark data, as I said, is over 1,000, represents over 1,000 locations. So it's quite a large amount of data. And this is an aggregate average at the store level, or at the business level. So this may represent multiple stores, but it includes one company's average data. So this is average data for one company. You'll notice that we've got two blocks here set up. And let me see if I can just get a laser pointer here to tell you. So this section right here in the top green box represents operating activity, and this represents non-operating activity. So as we look at this, this is a year-over-year comparison of 2019 versus 2020. And the period 2019 is in this sort of brown area that you see over here, and 2020 is in this section over here. And so you can see that we have, on an average basis, we had total sales income for this of $12.8 million, also about $12.8 million in the prior year. So 19 over 20, in terms of the overall aggregate data that we have for all types of companies, sales just barely decreased, it appears. Now let's see, yeah. Looks like it barely decreased year over year. Cost of sales represented 67.94% of the sales amount versus 68.6% in 2019. So what does this tell you? We had a decline in the cost of sales. What would that do for us? If we had a decline in the cost of sales and our sales stayed constant, we should see improved profitability from that. And that is indeed what you'll see happen down at the bottom. We had gross profit then, when you subtract the two, of 32.06% versus 31.4% the year prior. What does that tell you? It tells you that we improved as an industry, at least in the data set that we have, we improved profitability from 2019 to 2020 by roughly 66%. Now, that may not sound like a lot, but that's a significant increase in gross profits. Gross profit of 32% is, again, aggregated over the course of retail plus commercial plus builder. So there's a lot of variation in that, at least looking at it at this high level. Operating expense was 27%. In roughly both, it didn't change, and it gives us that operating profit of about 4.7%. Other income and expenses net that all the way down to the bottom line, just to get us down to the bottom line, for 2019 of a 4.39% net profit. That's what these businesses experienced. For 2020, however, that number was 6.51. Now, just to give you an example, I went back and looked at this 1994 report here, and the profit margins in 1994 were about 1.6, 1.8%. So something has happened along the way where profitability seems to have been improving through the years. In fact, I looked at the one in 2005, and it's about 2.6% up to about 2.7%. So through the years, it appears that profitability has been increasing along the way, and there is a marked 2% net profit increase year over year, 2019 to 2020. So when you look at that net profit line item, we're seeing nice improvement. At least we did from 2019 to 2020. Now let's go and take a look at what it looks like for 2021. And I'm going to only have data here for the first half of 21 versus 2020. And I'm just going to drop down to the bottom line here. And you'll notice that for the first half comparison between 2020, which by the way was a horrendous year, as y'all know, or at least first half, 2020 is when COVID hit. So we had this massive drawdown in the first half of business that when you do a comparison of this first 6 months versus that 6 months, you're going to see a significant difference. We had net profits down at the bottom of that of 5.34%. And then, so for the first half of this year, it's 7.37, showing a 1.97% increase. I don't believe those increases will hold as we get on through the year, because the comparisons get much more difficult in the second half of 21 than they were in the first half of 21. Simply because of what happened with COVID. We had the big dip, and then we had the return back up. Now, let's go in and define revenue a little more clearly, as I said before, because I don't know that you may not understand some of these terms very specifically. So revenue, again, is generally defined as cash inflow from the activities of your business. All right, and two types: operating revenue. Revenue is cash inflow from primary activities of your business, i.e. sales activity. You're in the primary business of selling floor covering and installation, and therefore that is your primary activity. And therefore sales of product and services, i.e. installation, is part of your revenue, operating revenue. Again, top line. Non-operating revenue is all those secondary activities. And I said interest is one of those, investment gains, whatever. Now, going from the revenue line item now on operating revenue, there is the idea of gross versus net. So gross is just the dollar amount of the revenue that gets generated. So really from your sales tickets, all of that just accumulates in terms of gross revenue. However, when you're looking at your performance numbers, you don't necessarily always want to look at operating revenue in gross. You really want to focus on the net. Why? Because net takes out some things that reduce your revenue that you should look at. So for example, if you offer coupons or discounts and they show up on a separate line item, they need to be subtracted from your gross sales to really get to your net sales. Sales tax collected. So if you have to collect sales tax, that will go into your revenue. You'll put that sales tax in your bank account, but that's not really your money, right? So that's going to go to the tax authority, whatever it might be. And so this sales tax collected is something you want to reduce your revenue by when you're looking at net sales. And then finally, returns and allowances. If somebody brings something back to your store or returns it to you, and you refund it, that has to come off of that. So that's the concept of gross versus net. And gross versus net applies not only to revenue, but expenses as well, as you'll see in a little bit later. Now, Again, this is our dashboard for our BI tool, our business intelligence tool, we call it. And I'm going to just dive into some of these things here on it. I'm going to look at revenue in a graphical form by segment. Once again, this is 2019 versus 2020. So if you're looking at your financials, and you're probably just getting your 2020s for last year because accountants are notorious for taking a long time to do taxes. But nevertheless, if you're just getting your revenue and income statements, you might want to look at some of these growth numbers and see how that compares with what you're seeing in your business. Again, benchmarking. So as I said, sales went down slightly year over year, 2019 versus 2020. You can see that 0.81% decline in average store sales within our data. And you can look by segment down there and see builder, commercial, Main Street, multifamily, retail, and wholesale left to right. And just at a glance here, I can see that builder went up slightly, 19 versus 20. Commercial was down slightly. Main Street was about flat. Multifamily was significantly down. Retail was flat and wholesale was about flat in terms of average stores. Our average store sales in this data set were $3.7 million. Is the average of the data that we have per store in this data set, not per dealer, but per store. Now, if you look at that same data, comparing the first half of 2020 to the first half of 2021, the current half we're in now or just finished, you will notice there's about $2 million in average store sales, up 18.1% or 18.2% from the 2020 numbers. That's again showing you that massive drop we had in 2020 and the comeback that occurred. So your first half is going to look great on your financials, or at least it should. Your second half, on the other hand, might be more difficult, as I said, because the comparisons, the comparatives get worse as you go along. And you'll notice that in the first half, you'll see that builder came back strong in the first half versus the prior first half. Commercial dropped some more. Main Street came higher, and multifamily went higher. Retail went higher, and wholesale went higher. So the only segment that has a year-over-year first half comparison negative is commercial, and it really took a hit to some degree. Now, I want to look at it in a net change, from a net change perspective. This again is going back to 19 versus 20, 19 versus 20. And you'll see that builder was the only one that increased at all, much at all. And commercial was down significantly, Main Street down slightly, multifamily plummeted from 19 to 20. Retail was about flat and wholesale down slightly. So that looks at it in terms of net change of revenue year over year, 19 versus 20. Let's look at that same data, if we can, for the first half of this year versus first half of last year. And you'll notice that it really, went up across the board with the exception of commercial. Commercial lost, it looks like, somewhere close to a little in excess of 15%, 17% or so in the data that we have, whereas the big gainer is retail. We see a big comeback in the housing market. We know retail really took off, the first half of this year. In fact, it took off in the second half of last year. And so that's sort of looking at the data year over year and what the trends are in our industry right now. You can feel that, I'm sure, in your businesses. This quantifies it to a degree and shows us where that's happening by segment of the market, because the data can be sliced that way in our intelligence tool. All right, so with that, let's go back now to our basic structure of an income statement. We've talked about revenue. Now let's talk about the second line item on there called cost of goods sold, or cost of sales. And so cost of sales, I'm going to look at these comparisons, and it's a little bit, I see a little bit difficult to read on there. I hope you can see it. It may be one of the charts here is not showing up very good. I apologize for that if that's the case. I'll try to give you a general feel for it. But in cost of goods sold, there are multiple components to cost of goods sold. You may think it's just real simply the cost of the product that I pay my supplier. It's just that cost, right? I buy, a yard of carpet or LVT or whatever it may be, and it costs X dollars a square foot. I buy 100 square feet and I multiply that out, that's my cost of sales. Well, there's more to cost of sales. In fact, there's a lot more that goes into it. When you look at your cost of goods sold, you want to include all of the things that you pay for to get it landed at your door. And then there's some other things that go with it as well, what are considered cost of sale items. One of those, of course, is cost of materials. That's the top one right at the top. That represented in the current, well, in 2020, which this data represented 46.16% of sales. So material costs were 47% of sales. And by the way, that had decreased from the prior period by almost 1% over 2019. And that, could be mixed, not necessarily just price differences. It could be mixed. However, the next line item is freight. So if you're looking at your cost of goods sold and you're looking at your P&L, you probably need to ask your accountant, but I would understand that to say your cost of sales would include the product cost plus freight, the landed cost of those goods to your business. And then, of course, then you have installation cost. Installation costs are a cost of sales because installation revenue is a part of your revenue. So you've got installation cost, installation revenue. And so your subcontractor labor that you pay for all your subs, that's a part of your cost of sales. And that goes into a bucket as well. Also, if you have employee installers, then you have salaries and benefits associated with those employee installers. And that also is a cost of sales. Those costs don't need to get put down into your operating expense where your warehouse salaries and wages are, or your back office staff is. Installation labor is a part of the cost of sales, whether they are subcontractors or whether they are contractors, and they need to go up in that cost of sales item. And then purchase discounts. If you take 2% 10 terms with your suppliers or whatever your terms may be, that reduces your cost of sales. And so they get subtracted from your cost of sales as purchase discounts. Claims, if you file claims and get paid for those claims, that lowers the cost of your sales. Samples and display is generally considered a selling cost and brought in as part of your cost of sales. Use taxes, if you're in a state that requires use taxes, you'll know that, and that'll be part of your cost of sales. And then any other miscellaneous cost of sales that might go in that. That all adds up to cost of sales, which factors into the whole gross margin equation. Again, let me go back and look at the prior slide. So in 2020, the total cost of sales was 67.34% versus 68.6 in 29. You can already probably calculate what your gross margins are, right, from that. But in 2021, those were 67.88 versus 67.85, first half versus first half, 20 versus 21. And so the cost of sales decreased slightly, which is really odd to me in the world of inflationary pressures that we're seeing right now, that it really hasn't altogether showed up in the cost of sales in these aggregate numbers. Now, there may be reasons for that. As I said, mix is one of those. It could be that the data set has a different, different size businesses that work off of different things. But in aggregate, with the amount of data that we're looking at, I don't see yet, at least in the first half of 2021 versus 2020 as a whole, or the first half of 2020, either one, or 2019, I don't see pricing pressure in the cost of sales numbers that we're seeing here. Again, your situation might be different, but I just don't see it showing up yet. Not that it's not going to show up, it probably will. But somehow or another, we figured out how to keep our cost of sales relatively flat, if not declining, which are improving our margins overall in, again, this 1,000+ dealer data set. All right. So that's cost of goods sold. That gets you from revenue minus this cost of goods sold into this thing called gross profit margin. Now, I'm going to look at gross profit margin a couple different ways. The first is I'm going to look at it 2020 versus 2019. Again, I'm looking at these two periods of time because I think they're relevant to us, and that's what we have in terms of the data. You'll notice that the gross margins expressed as a percentage of sales, and that's the way gross margins should be expressed. Gross profit, which is the dollar equivalent of that generally is the way we separate the two. Although, again, a lot of these use them interchangeably. The gross margin in a percentage is essentially your gross profit, which we looked at right here, right? Gross profit in dollars divided by the revenue, the total revenue. That's how you get to gross margin. It is not divided by cost of sales. It's divided by revenue. Next week, I'm going to talk, or next time, I should say, I'm going to talk a lot more about margin versus markup and things of that nature. But what I want you to see here is the comparison between the two. So in 2019, which is in that middle section right here, we showed gross margins overall of 32.82% versus 33.28 in 2020. That was an increase of almost a half a point in just pure gross margin numbers, all right? And you can see that gross margin broken out here by segment. Let me see if I've got a slide no, I don't have a slide that expands that. But nevertheless, you should be able to see that builder margins actually went down slightly. Commercial went up slightly. Main Street's about flat, maybe a slight increase. Multifamily gains, pretty good there. Retail gains significantly. So your gains here, wholesale's about flat, are in multifamily and retail. So we were able to see some nice pricing ability and or cost reduction, because those are the two things that drive these gross margins. We were able to see some movement either in one or the other of those, and it looks like it's in the cost side of it to help improve our margins from in that period. So in 2021, first half 20 versus first half 21. Again, 33.33% margin versus 32.9 in the first half. Our margins have continued to improve from the first half of 2021. So gross margin is a very, very important part of profitability for a store, for a dealer. And, we're going to get into that in much more detail, as I said, as we go along. But looking again at it really just this top line number, these top three line numbers. Today, we've really focused on three things. We focused on revenue, and really only the operating revenue, the sales revenue of your business as the first one. And we have focused on the cost of goods sold, the cost of sales, all of those costs for acquiring product and labor that you sell, and then gross profit. We looked at those first three things, and those are only three items that are part of the income statement. And so, but they are very, very important items. If you don't start with adequate gross profit margin in your business, you really are under a great deal of difficulty to pay for all of your expenses if you don't start high. If you give away margin at the top, then you're giving away much more than just expense dollars. Expense dollars are, you can cut expenses all day long, but if you don't start with a high enough gross margin, you can't save your way to profitability many times because your gross margins are not where they need to be. Now, gross margins, I'm going to tell you this, they vary greatly between the type of business that you're in. You know this. If you're in the commercial space, you're going to be operating on a totally different gross margin set than you are if you're in retail. Same way on the builder side, or wholesale if you're in the distributor business. And so I've got data on all of that segmentation. I just didn't have time to go through it all today. We plan to have some sessions down the road that are specific to maybe builder or specific to commercial that will parse that data out for us and let us see some of that in more detail by segment. Again, just can't do that necessarily in one our first session when we're just introducing this, right? But nevertheless, gross profit is probably one of the most important things to get right out of the gate. And next week, I keep saying next week, next session, I want to dive deeper into how cost and selling price, both for product and labor, affect your top line revenue, your cost of goods sold, and gross profit. We're going to look specifically in that. And we're going to learn the concepts of markup, margin, what the difference between those two are, and how to calculate them. With that, when we learn those concepts, we're also going to learn how to properly calculate and set the prices of product on your floor, as well as your labor, to grow your revenue and maximize your gross profits. There are some very, very little tweaks that you can do that will make major, major impacts to gross profit, which will fall right down to the bottom line if you hold your expenses in place. Even if you don't reduce expenses, if you can tweak your top line revenue and increase your revenue, or you can lower your cost of sales, you can move that gross margin line enough to work and it'll fall straight down to the bottom line. And it doesn't take but little tweaks to fix what might be problems in your business. You may be leaking funds or leaking profits in your product pricing schema. That's where I find, as I was consulting with many businesses over the years, one of the first things I find is leaks in gross profit. I mean, it's very easy to do, particularly if you allow your sales force, for example, to negotiate prices on product. And maybe we'll talk about some of those issues as we get going, but do you allow your sales force to set product pricing, for example, or do you do that yourselves, or do you have someone that is really versed at this, setting prices for your business and controlling that in such a way that you don't lose or leak that gross profit dollars? So setting those prices, but also working on the cost of goods sold side. There's a lot of things that you can do that we'll talk about the next time to reduce the cost of sales. And it's not always just about negotiating better prices with your vendors. Sometimes that is what you need to do. Sometimes that's available to you. But sometimes there's other things you can do to lower your cost of sales that I want to talk about that might not involve renegotiating prices with your vendor, with your supplier. So that's kind of what we wanted to kick off with. That's about all I wanted to cover on the first session today. I know it's new. For me, it's very exciting. I hope you are getting something out of it. And as I said, we've got much more to come. I wanted just to kick it off today with a sort of a high level attack here on the income statement and just get you familiar, if you're not already, with these financial concepts and terms, particularly those that impact the income statement, your P&L, and familiarize you with that and get you started on it. So we've got about 15 minutes left in the hour, and I had planned to have 15 minutes left. If anyone had any questions or comments or thoughts on what we've covered today, any particular questions, anything I can answer for you in regards to the content that we've covered today. And also, let me also say this, and by the way, if you have a question, I want you to submit it in the Q&A area of the webinar. So I believe we're broadcasting this on Zoom. It should have a Q&A section down at the bottom, or a Q&A button. If you'll hit that Q&A button, you can type in a question. It'll come right up on my screen in front of me, and I can do my best to answer that question. And again, as I said, if you don't have a question now, but a question comes back later, we will certainly try to address that. I'll try to respond to that either directly or in the forum here, or at a later time when we're broadcasting a new session. So we've got a couple of questions coming in. One is there a schedule of topics to follow? Not yet, but I plan to have one. As I said, I've given you what we're going to talk about next time. That's about as far ahead as I've got in formality yet. But I do plan to put together a full schedule for the next few months, so that you can kind of see what's coming down the road and be able to sort of anticipate what we've got, maybe tune into the ones you think are more applicable to you. As I said, we've got so much content to cover. You sort of have to, in these sessions, cover it at a sort of a common denominator. And so part of it, I have to sort of start at the entry level of understanding on finance and accounting, but I plan to get much more deeper into this as we go. But yes, I will do my best to bring a schedule to it as soon as I can put it together. Merchant processing fees. We've got a question from Ryan. Says, would you consider merchant processing fees to be a cost of goods sold? Not typically. Typically, they go down into bank fees, which are part of the cost of financing operations, not part of sales operations. Now, again, your accountant, your bookkeeper may treat those differently, but typically what I see is the common idea is to include those down in an operating expense as a bank fee line item under financing operations, just like you would interest on a loan you might pay, for example. Interest on a loan that you might pay are, once again, non-operating expenses. So if you've borrowed money through a line of credit, you have to pay interest on that. That's not going to be part of your operating expense, of your gross margins or anything like that. Cost of goods sold, that's going to be a part of your operating expense line items. Or in the case of something like a bank fees, you can make those either operating expenses. I would consider those operating expenses, non-operating expenses. The next session is probably going to be, someone asked the question, when is the next session? It's probably going to be in about 4 to 5 weeks, hopefully. We're trying to do one of these per month. I'm not going to promise on that. I've got to have a little bit of surgery coming up in about a week. My goal is, as soon as I get back to that, to do the second session. But our plans are, in terms of schedule, to do about 1 session a month. By the way, let me also refer or tell you about some interim things that we're going to be doing that are connected to this. So in addition to Profit Matters, I'm going to be doing some sort of 3 to 5 minute weekly sessions that we send out over email, much in the way we do like with Tom's Tips or Leadership Live that Scott Humphrey does. I'm going to be doing some sessions like that, 3 to 5 minutes on just short learning segments. And we plan to do those weekly, and they'll start up here again in about 4 or 5 weeks when I'm able to get back, and we'll start tackling those. But I'm very excited about both of these. Profit Matters is more lengthy. It's more 1 hour in time. Those bottom lines are going to be 3 to 5 minutes, easily consumable and sent out via email. But yeah, that's what we plan. All right, so next question from Monty. We have our subcontractor installer labor under cost of goods sold, but our in-house installers under operating expense. And he says, you mentioned having both under cost of goods sold. Explain why. Well, because those costs of staff labor, and I'm talking about where you're paying their salaries, benefits, they're employees of your organization, since they are directly tied to the installation revenue line item on your P&L. Remember, revenue is both the revenue for the products you sell as well as the labor revenue that you collect for labor. And by the way, this is an aside. I'm glad you asked the question, because this is an aside to that, is that if you're not making a profit on labor, you're leaving a lot of money on the table. I find oftentimes that people just simply pass through the cost of labor that they have either from a subcontractor or their employees. They just simply pass that through. You should be making margin dollars, i.e. marking up, or making margin is really the more proper way to say that, your labor cost, because that's profit opportunity that you're leaving on the table if you're not doing that. We'll talk about more of that when we get into the next session, actually. But back to your question, installation labor, whether it is a subcontractor or an employee, is part of your cost of goods sold, because it has to be tied to the revenue. So in terms of accounting best practices or GAAP or whatever you want to look at it, we would consider those two both part of cost of goods sold, because they are direct cost of the things that you sold. You sold labor and you sold materials. So the cost of materials and the cost of labor, wherever it comes from, is part of your cost of goods sold and should be part of your gross margins. Hope that answers your question there, Monty. Let's see what else we got here. Scroll up just a little bit if you would, and let me see that top. There you go. Nope. In the chat. There you go. Thank you. These are just comments. Okay. Make sure I got any questions in there. Oh, someone asked a question here. Should salespeople's salaries and commission be included in the cost of goods sold? Well, that's a great question. In terms of pure gross margins, sales commissions and sales salaries, while they are a cost of selling, I don't typically see them necessarily in the cost of goods sold. That varies. I will tell you that varies. Usually what happens is you want to calculate your gross margin first before you reduce it by selling expenses like salaries and wages. What a lot of accountants do and what a lot of bookkeepers do is they break the reports out so that you can see your gross margin when it's only calculated against your product sales and your labor sales minus your product cost and your labor cost to get gross margin. They don't typically include sales labor in that first gross margin line item number. But right underneath that, what I have seen a lot of times is that they will have another line that gets reduced that will be selling expense. And that's where the salaries and commissions for your salespeople might go. Again, everybody does it differently, but from my perspective, I like to see, as a business owner, my efficiency in reselling those things that cost me money. So I have to pay for labor and I have to pay for product, and those are the two line items that I sell. I really don't sell salesmen. I guess that's a great way. I don't sell the salesmen or the salespeople of your business. They're a cost of doing business, but it's not something I'm selling. So I generally like to see those on a separate line below the gross margin line. And I think it better reflects your efficiency at turning your cost of sales into revenue. And selling expenses is just a portion of that gets deducted down in operating expenses. Will you be able to rewatch the video? Absolutely. We're going to be posting this, I believe, in our WFCA University website. So you are welcome to go there. If you haven't signed up for WFCA University, please call our offices and do that. We'd love to have you as a part of that, because it's where we're going to host these sessions, is in the WFCA University. It's basically our online repository for all of our learning that we have, and all of our members have access to that, and they'll tell you how to get that and what that requirement is or whatever. But yes, that will be there. The 3 to 5 minute bottom line sessions will be published on our website and probably on our YouTube channel, and you will not have to go to the university for those. But for these hour-long sessions, we're going to put those, I believe, at least initially into our WFCA University platform. What is your thought on variable commissions being included as cost of goods sold? Well, I would say that in a sense where you have a variable number there, again, I've seen it both ways. I think this is Jim asking that question. I've seen it both ways. Certainly on fixed costs that if you just pay your commissions, or should I say, if you pay a flat salary to your sales force, then I would certainly include that down below that gross margin line, because they're really like any other management staff that you have. They're on a fixed salary, and it doesn't vary, as you said, by the dollars of sales. If you have a pure commission portion, there is another way to do it, and this may be what you're alluding to there. You could take and put the salary part of a salesperson's cost below that gross margin line in salaries and wages as an operating expense. And then you could take the commission earned, which is directly associated with the sale and is variable. You could take the commission portion and put it up in your cost of goods sold. That is probably also an appropriate way to do it. If you have a salary commission structure in the way that you pay your salespeople. Again, I think there's a couple of ways of doing it. I would actually refer you in terms of that to your accountant and discuss the pros and cons of that. And if at the very least under the cost of goods sold section, you want to break those out as a separate line item and be able to see what those are apart from the product cost and the installation cost, which are two of the things that you're directly selling. Okay. Next one, will the slides be available to us? Yeah, sorry about the hard time reading them on the Zoom. I'll try to improve that. We're working through this new technology, and I realized that was a difficult to see. It's perfectly clear on my screen. However, when it got to your screen, it was not perfectly clear. So I think that has to do with maybe the Zoom. We'll try to figure that out. But yes, the slides I will try to make available to you if you need them. Be perfectly happy to do that. Next question is how do we see the recent manufacturing material price increases affecting top line revenues? That's the first part of the question. Well, it could. Remember what I told you earlier, that the sales increases that we have comparison year over year, there's a lot of things that impacted those. If you look at 2021 versus 2020, we had that big drop in the first half. And so we saw this real rebound in the top line revenue. Of course, top line revenue, if you have received price increases, it's going to affect both your cost of goods sold, obviously, but it's also should, in fact, affect your top line. So part of the top line growth may simply just be price increases. I'm sure part of it is. If you have received a price increase and you put that in your product cost and pass that on to your customer, your revenue is going to go up, your cost is going to go up, and you might be slightly better off by making a margin on that diff, on the difference between those increases in revenue and increases in cost. But for the most part, you're not fully benefiting from revenue because your cost is going up too. But I don't have a clear way to quantify direct price increases affecting the revenue top line for this data. I can't break that out specifically because I can't see it in the data, unfortunately. But it will definitely affect the top line if you pass those on through it. And then it says, how do you calculate that your business revenue is not just increasing due to those price increases? Well, you would have to have a little more refinement in the ability to get down into the weeds of your data. So one of the things you would have to do is be able to get a sales report by product from your software, whatever accounting or business management software that you have. The only way I would know how to do it is to get a printout or a spreadsheet, should I say, of your activity by product and look at the quantity that you sold and the price you sold it at, and put another column in as what the old price was prior to the price increase. Multiply that out and check what the difference is and sum them up. That's the only way I know how to do it. Most of the software I'm aware of, I don't think they can do that. Possibly, but I don't think they can do that. If they can, then I would stand corrected and would love to know that. But it's very difficult to know if I'm just getting price increases and I'm putting that into my revenue line item because I'm bumping my prices up. How much am I really growing my business? It's very difficult to know. The other way to look at it and know it, at least in rough form, is look at unit sales. So when you're looking in terms of dollars, it's very difficult to see unless you do what I said in a spreadsheet. However, if you look at it and have the ability to dive into unit sales year over year in the software, which I don't have access to, I don't believe, in our tool. But however, if you've got access to unit sales years over year, you can see that trend in units. That will tell you if you are indeed growing your business. So did you sell more square feet or square yards of a particular category this year versus last year? If you did, you're likely growing your business, and your revenue increases are to be attributed to that increase in volume. If you're not growing your volume and your revenue's going up, it's probably price increases. Again, trying to quantify that is very difficult to do. So hopefully we're just about out of time. I think we are. It's right up at 3 p.m. And so I think it's probably time to close it up. We got one more question. Let me see here. So one of the questions we had was that RFMS allows users to enter an overhead margin. Do you find an average margin entered by most RFMS users or more profitable users. I don't have access to that particular piece of information, unfortunately, in the data. I'll look though and see if I can get a hold of it. I don't have it off the top of my head of how that works. So I can't tell you right now, but I'll see if I can find that answer. I'll go back through the questions, see if I can find it and answer it for you. All right, we're going to cut it off there today. I hope it has been informative and beneficial to you. As I said, we're sort of starting at the ground floor here, but we're going to dive deeper. I really would love to be able to share with you some deeper ideas on improving the profitability. We didn't speak a whole lot to that, but we're going to tack that head on in the next session as we dive into calculation of gross margins and how to get the most out of that in the next session. I hope you'll join us, share the word, give us your feedback. Certainly, I'm looking for feedback. This is the first one I've done. And if it was great, let me know. If it wasn't great, tell me. You probably won't hurt my feelings. And if you do, I'll get over it. So just let me know what you're looking for, how I can help you further, and how the WFCA can help you improve your business. That's what we're all about. Thank you for your time this afternoon, and we'll see you on the next session.